Hi, everybody. Thanks for joining me. Before we get started, I'd like to ask you to hit subscribe to my channel to keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen for a message from our sponsor, The Motley Fool, where you can get the 10 best stocks to buy right now. Hi, everybody. Thanks for joining me. It's a special episode today because I am joined by Kevin Ortner. Kevin is the president of Appreciate, which is more commonly known for its brand name Renters Warehouse. So, Kevin, thank you so much for joining us today.
Yeah, thanks for having me, Matt. Great to be with you.
So, as I mentioned, Renters Warehouse is what you're known for. You're getting set to go public. So, before we get into the details of the IPO or and all that, can you kind of just give us an overview of what Appreciate does, what Renters Warehouse does? You know, how should investors kind of think of the company?
Yeah, great. Well, thanks again for having me. Appreciate through our operating company, as you mentioned, more commonly known as Renters Warehouse, is an end-to-end platform for single-family rental investors of all sizes. So we help people invest in single-family rental properties across the United States, whether that's someone who maybe owns one home, maybe they've built a small portfolio of homes, or even someone who hasn't yet started investing in real estate but would like to. We provide tools, technology, and full service property management to help make that easy. And we also do that all the way up the scale for institutional investors into single family rental. As I'm sure you're aware, there's more and more institutional capital flowing into single family rental homes. So we do those same services from acquisition, renovation, and ultimately property management for larger institutional clients as well.
There are two things that kind of stood out to me about you. One is that you're going public through SPAC, which we'll get to in just a second. And number two, on the surface, this seems like a just from an outsider's perspective, a bad time to be taking a real estate company public. We've all seen. I mean, you probably have watched what happened to companies' stock prices like Redfin and Zillow over the past year or so. So a lot of investors just think the timing's weird. So what makes Appreciate different, and how can Appreciate still do well in this type of market?
Yeah, great question. I appreciate that question as well because we get that a lot as we're out talking with public market investors. And I think the biggest thing to note there is our business really is while we're in real estate and we're helping people buy and sell single family homes, we're doing it for a very different type of buyer. And we also have a base of property management business that really helps keep our revenue stable and growing. And so you hear about the Redfin, Compass laying off people. To your point, stock price dropping in this market. There's some dynamic of this challenging real estate market that's actually helpful for our business, right? And so while we're not actually buying and selling homes for first-time home buyers or move-up buyers, we're working with, like I mentioned, smaller retail investors who may today, be taking a pause and sitting on the sideline a little bit with interest rates and trying to see what's going to happen with rents and will the numbers work. But ultimately, as we know, 7% mortgage, fairly common, fairly average. People have been buying investment properties and investing in real estate, for a long, long time, and it works with a 7% mortgage, but we have to have things kind of settle in there a little bit. But we are, in some ways, for our clients who are buying investment properties today, this market's actually beneficial. 9 months ago, the beginning of 2022, if you can believe it was just 9 months ago, still very different real estate market. We were putting out offers on, hundreds of homes a week for some of our institutional clients, helping them build their portfolio, and they might win 1 out of 10, right? Because they're out competing and bidding against owner-occupied buyers who maybe had already lost out on 10 homes, 8 homes, 15 homes, and they weren't going to lose this one. So they were, paying maybe significantly over list. And when you're buying a home as an investment, obviously there's a yield calculation that comes into play and you can only pay so much. Fast forward to today, as we're out putting offers on homes, we're winning a significant number more of those properties because the bids are different. There's not as many multiple offers on homes, and our clients are actually winning more of the offers that they put out. So that's good for our business. And I think the other side of why we think our business is very resilient through turbulent real estate markets or challenging times like this in the market in general is we do have a very solid base of recurring revenue. So we manage about 15,000 homes across the country on our platform today, and that creates that ongoing monthly recurring revenue for us. And that base continues to grow. And so even if transactional sales in our business or transactional commissions are down, we have this continued revenue base of the monthly management fees in our business, which makes for, a solid revenue base. And frankly, right now also our customer lifetime is increasing. What we were seeing 18 months ago, 2 years ago, or even 12 months ago, is some of our retail customers who had record equity in their homes are saying, hey, maybe this is a great time to take advantage of this really hot real estate market, sell, pull some cash off the table and reinvest somewhere else, or wait for the market to change. And so we had more churn on the platform, mostly due to people selling their home. And obviously today it's not an obvious time to sell. So we have fewer people selling properties off the platform, which in turn creates longer customer lifetime and more value for our business there as well.
I kind of feel like, just based on my own experience in single family rentals, that you see a lot more cash buyers than in the overall market. So it might be less sensitive to mortgage rates, just to kind of, another kind of interesting dynamic of the industry, if you will.
That's right. Yep.
And I also appreciate you saying we're only 9 months into 2022. I feel like I've been in 2022 since I was 14 years old.
I know.
So, so you are now listed under the ticker symbol SFR on the NASDAQ. I'm going to go out on a limb and assume that stands for single family rentals. That makes you the first single family rental marketplace and management platform to go public. And as I mentioned, you went public through a SPAC, which was really big in 2020, 2021, but not so much today. But there are still a lot of SPACs out there, more than investors seem to realize. So why did you decide on this particular route to go public?
Yeah, well, first off, you're right. Our ticker SFR stands for single family rental. We figure, we're a first mover in this space. We're the first single family rental services provider to be a public company. And, if we're going to, what we want to do is be a big player in this industry, dominate the industry, we might as well own the ticker symbol as well. So SFR, single family rental. And yeah, going public through a SPAC was really a natural route for us, right? We believe we've got a great product, great technology to bring to market. And what our business really needed was access to more capital to continue to market and expand and bring customers onto the platform. So being public made sense for us. And frankly, with where things had been heading in the markets, SPAC really provided us more deal certainty and a certain route to getting done versus a traditional IPO. And I think that's proved to be correct, because the traditional IPO window is fairly slammed shut right now in the current given market. And so we're happy we decided to do this. Our partners at PropTech Investment Corp 2, the SPAC that we merged with, were fantastic through the process. They're seasoned professionals at this. So we thought we had the right partners and the right strategy, and our business was the right candidate for merging with a SPAC in an appropriate way to get access to the public markets.
So let's talk a little bit about the industry and the opportunity here, because going public, you're a relatively small company in terms of market value and things like that compared to the overall stock market landscape. So the property management industry on all sides of the business is very highly fragmented. A while ago, I talked to the founder of Vacasa, which is I would say like the closest company to you on the vacation rental side of the business.
Okay.
And he mentioned that they managed about 20,000 properties, and they were the number one in the industry out of millions of properties. And the same is true in single family rentals. It's such a highly fragmented industry. No player in the industry has more than a 1% market share. So my question to you is, one, why not? Why has nobody been able to achieve a 1% market share yet? And how is Renters Warehouse going to get there?
Yeah, it is amazing. This huge industry with a lot of different players in it, different tech solutions coming to form. And to your point, no one has more than 1% market share. And I think it starts with the general size of the market, right? Depending on what stats you look at and kind of what you include in single family rental, there's anywhere between 16 million and 22 million single family rental properties across the country. And the varying number there is if you include duplexes, up to 4-unit homes or buildings in that SFR term, similar to what you would in the mortgage world. But 16 million standalone single-family rental properties across the country. And by the way, 90% of those are owned by retail investors. What we mean by retail investors are those who, they own 1 or 2 homes, maybe up to 5, 6 homes. But this is not the multifamily world where it's become highly institutionalized and 70% or whatever the stat is of multifamily properties are owned by institutions. This is still very, very highly fragmented, which leads to a highly fragmented service provider base as well. So there's something like 80,000 smaller mom and pop property management firms across the country that are doing this work for people. And that might be a realtor who's managing some homes on the side for extra revenue or doing a great service for their customers. And maybe they manage 50, 100 homes. Businesses that are managing a couple hundred to maybe 1,000 properties in a local market. But the challenge really with single family rental historically has been we've lacked the right technology and infrastructure to really manage these scattered site homes at scale across the country. And we learned that ourselves as we were growing our business and moving from being in one market. We started our business in Minneapolis, Minnesota, and are now in 40 markets across the country. The existing technology solutions, off the shelf, tech service providers for our business just really couldn't meet the demands of what we needed to scale. And at that point, we took a pause on our expansion and designed and developed what we thought was the right platform to really grow this business. And so that's what we've done. We now have proprietary technology tools, both customer facing and internal facing, that just make this business work from an efficiency perspective, from a consistency and communications, transparency with our customers. So I think, going back to the root of your question, why has it been so fragmented? Why hasn't anyone been able to achieve over 1% market share? It's a newer industry from an institutional perspective. Institutional buyers really didn't come in until after the 2008 housing crash, which kept it very, very local. And I think beyond that, as businesses have tried to expand, run into a lot of hurdles that, technology is now helping solve. And we had to develop some of that own technology on our own.
So you already almost answered this question. I own single family rentals in 2 different markets. So I have 2 different property managers. One of them is fantastic. The other one, let's just say, leaves a lot to be desired. Having a good property manager can literally make or break your experience as a real estate investor. So what makes your platform different? Like I said, you already gave us a lot of it, but like if I'm buying my first rental property, why would I go with Renters Warehouse as opposed to the mom and pop property managers as you were referring to?
Yeah, great question. And that's one of the things we're trying to do is solve for how do you as a real estate investor own properties in multiple markets across the country. There's great reason to do so, exposure to different areas, different appreciation rates, cash flow profiles, yields, et cetera. How do you do that and have a consistent experience, right? And so that's part of our desire to continue to expand and also build this technology platform. And what we bring to the table for especially investors like yourself, and probably many of the people here listening to this, is we take an institutional quality technology platform, those same tools, technology, and data sets that we deploy for our institutional clients, we bring it out to the everyday investor. And so more access to data and insights and understanding how to appropriately price your rental property to ensure you're achieving maximum rental value. We have scale in all of these markets that we're in, which allows us to keep maintenance prices and maintenance costs down as we get volume discounts from vendors we work with. So there's fundamental things like that just around the profit and loss statement around a property, but also then this technology that we've brought to market really allows for a transparent experience as a property owner. And I think that was one of the biggest challenges we saw as we were growing and building our business was this is really a logistics business, right? We have a property owner like yourself, Matt, to deal with. We have a resident in the home who's also a customer of ours. We have vendors involved in repairs and maintenance. We may have other parties involved as well. There's a lot of communication and things that have to happen. And so when we set out to build our platform, communication was top of mind for us. And how do we ensure that the resident is always informed on what's going on at the property? How are you as an owner always informed? No surprises, right? The favorite story I like to bring here is when I was getting into this business myself over a decade ago, we got a lot of stories from frustrated investment property owners saying, I didn't know that there was a $650 repair done on my property until I got my statement in the mail. This is when we were still getting statements in the mail, right? And that's frustrating, especially if you're planning on cash flow and that kind of stuff. And so what we try and bring is transparency to the entire process, up-to-date real-time metrics, KPIs, and performance measurements on the properties. And just, it's all about transparency for us. And I think that's a game changer.
It's my experience summed up perfectly. My great property manager is in the Orlando market, and its communication is just off the charts good. We've had 2 major tropical storms come through this year right over the house.
Right.
And I have zero worries that the property is going to be taken care of. I'm in the loop 100% of the time. The other one, like you said, I get charges on my statement that I didn't know they replaced the water heater until they sent me a bill. And it's the communications is a big consumer pain point. So you already kind of talked about this a little bit, but at the end of the day, we are investors. This is a show for investors. So I want to talk about the economics of your business. One, how do you make money? And I know you mentioned that your revenue is very front loaded. Like you get a lot of your, when you acquire a new customer, you get a lot of revenue right away. So can you talk about just overall how you make money, like fees and commissions, things like that? And, how the unit economics work?
Yeah, definitely. Happy to do it. So one of the things that's unique to our business is we're not just a property manager managing homes, getting that recurring revenue. We're not just a marketplace business selling homes and doing that one and done transaction. So we do have a marketplace platform as part of our business, and we do have a property management platform, but we bring them together to create this end-to-end offering for real estate investors. And what that does for us is really create a very diversified revenue model. And so essentially, if we look at a property life cycle or a typical experience we might find with a new investor coming in and saying, hey, I'd like to invest in a property in Kansas City, or even one of our institutional investors who's leveraging us across our services to help them grow their portfolio, there's really 4 big revenue buckets. And as you mentioned, 2 of them, or really almost 3, are very front loaded, which is great for, of course, for our business. And so from the beginning, there's a property acquisition where we're helping that customer buy a new investment property. We're collecting a sales commission on that. And that's been averaging about $7,800 for us. So we're essentially the buying side broker on that transaction. And our average home that we're helping someone purchase is about $350,000. Then after we purchase the home, it moves into renovation services where we're actually renovating and helping get that property ready for rent, where we collect a renovation fee for overseeing that renovation if that's needed. And then moving over to management, where we first place a new tenant in the home, where we're collecting a leasing fee or a leasing commission for placing a new tenant, and then ultimately moving into, say, month 4, after all of those other 3 steps, where we're creating that recurring revenue I mentioned earlier, which is about $149 a month per property between the property management fee and the other fee stream income that come along with it. So it's those 4 main revenue buckets how we make money. And as you mentioned, that property, the commission on buying the home, front loaded at the very beginning of life cycle, renovation fee, and that leasing fee all happen inside the first 90 to 120 days of a new customer coming on board for a property.
So your latest presentation mentioned a $145 billion addressable market opportunity, which kind of surprised me. So what does that include, and how big could do you think the business could scale to in the the next 5-10 years, something like that?
I think the 145 billion total addressable market is massive, right? And that a lot of that comes from the marketplace segment where we're helping investors buy and sell homes. According to the National Association of Realtors, somewhere around 20% of all homes sold on average over the last, say, 20 years have been sold to investors. So, there's a large portion of the $95 billion of annual brokerage commissions that are single family homes that are specific actually to what we do on a marketplace, which is geared towards investors. That's about 20 billion of that. And then on the management side of the business, there's about $50 billion market for managing residential real estate. Now, some of that includes multifamily, et cetera. So the direct addressable market for us there is about 17 billion. So if you bring that 20 billion and the 17 billion together, called $40 billion, is directly addressable today by our marketplace business, specifically for single family homes and specifically for managing single family homes. So that's huge, right? As we talked about, nobody has more than a 1% share. And I think the exciting thing for us, and one of the reasons why we decided to merge with a SPAC and go public, as we were talking about earlier, is access to capital. We've been fairly cash constrained as a private company the past couple of years, putting a lot of resources in developing technology. We talked about that platform. And for us, continue to grow the business and address this market share is about customer acquisition. And we have great historical results with customer acquisition. In fact, if we look back in history of the company, there's a 95% R-squared correlation between marketing spent and properties added in our management. So hugely correlated. So for us, what's exciting is to go after and continue to take big bites out of this addressable market and be that firm that has more than 1% market share. Is about customer acquisition on the retail side. We know how to do it. This isn't us having to invent anything new, create new products and services, any leaps of faith in technology. This is just doing more of what we're already doing on a broader scale and investing in customer acquisition to be able to take advantage of our customer lifetime value to grow the business. And so that's how we look at it, is we're going to go out, market and advertise things we've done in the past and really scale this business that we really have a great platform to expand on.
Okay, so I have two questions left, and they're pretty quick ones. The latest projections, I know you did an investor presentation, called for about 89 million in revenue next year, and what surprised me, profitability. The words SPAC, IPO, and profitability haven't always gone together, if we're being totally honest.
Sure.
So do you think that this is still achievable? Because, like you said, 2022, it feels like it's been going on for 13 years now, and a lot has happened since since that presentation even.
Yeah, absolutely. And man, a lot has happened. The numbers you're quoting there, 89 million in revenue in 2023, is from an updated set of projections we actually did in September. So we're taking into consideration much of the market dynamics that's happening here today. And so we believe this is achievable with the proceeds from our business combination with the SPAC, having access to that capital to be able to invest into customer acquisition. There's something like $15 million is what we plan to spend in marketing and customer acquisition next year, which is going to drive a growth of retail properties of over 7,000 doors. And so that alone is, we see a real solid path that, as I mentioned, the correlation between marketing and properties added in the past. And then also we have a lot of momentum in our institutional business with these larger funds coming in and wanting to deploy capital into the single family rental space. So yeah, those are some updated projections. We believe they're achievable given the right capital coming into our business. So we're excited about that. And I think just on the profitability perspective, you chuckle there. That's also why we believe we're a great candidate to have gone public via SPAC in today's market, is of course investors now more than ever are looking for businesses with good fundamentals, businesses that can achieve profitability over the long term. And it's something that we've proven we can do in the past. We've been EBITDA break even for several years. And the marketplace, which is a newer piece of our business for us, doing that transactional services, high margin, and really contributes to us being able to grow EBITDA over time.
Yeah, it's been really rare to find profitability essentially from day one from a newly public company. So last question, real quick one, just a kind of fun one. Is now still a good time to buy a single family rental?
I love this question. I get it a lot. Yes, but now I obviously very biased. I've been investing in real estate, specifically single family rental, for nearly 20 years. I've bought homes when interest rates were 7%. I've bought homes when interest rates were 3%. And at the end of the day, I view buying a rental property as a long-term investment, right? You're not fixing and flipping it. You're not owning it for probably 2 or 3 years. It's a 5, 10, 15, 30-year investment. So my answer to the question is always, if the numbers work today, meaning you can buy the house, you can put down some money, get a mortgage on it, and whether you're looking at it from a yield perspective or as a lot of retail investors do, smaller investors, cash flow, like what's my monthly cash flow in the home? Here's the deal. This is such an incredible opportunity investment opportunity for everyday Americans because it's one of the only things that, as everyday Americans, we can actually leverage to buy, right? Hedge funds can leverage, buy everything because they're a hedge fund. Ordinary Americans can't. So you can walk into your bank and say, hey, I want to buy a $100,000 investment property, and they're going to give you a big portion of the money to buy that property. If you walked into that same banker and said, I want to buy $100,000 to buy Apple stock, they're going to laugh you out of the bank, right? So this is an incredible opportunity. Not only can you leverage your purchase of an investment, now you have a tenant paying down your mortgage for you. You're taking advantage of fantastic appreciation we're seeing in the housing market now, and that's slowing. But if you look at historical, it's 3 to 4% a year. That's great. You have tax advantages with the interest deduct, all sorts of great advantages of owning investment properties. And so if the numbers pencil today, yes, absolutely buy it if you have a long-term perspective on owning that property. The long term, if the numbers work today, they're going to work in 10 years if you have a fixed rate mortgage. And, worst, best case scenario, mortgage rates go back down, you refinance, and it's an even better deal for you. So I say yes, you can find the right deal and you're a long-term investor.
Really good point you brought up there that mortgages, a lot of people forget this because you see headlines, 7% mortgage rates. Mortgages are a one-way renegotiation. If market rates go
Right.
down, you could get a 3% mortgage like most people did in the past couple of years. If they go
Right.
up, your bank can't do anything to you. If the market rate goes
Right.
to 10%, they can't do anything to you because you've already locked in your rate. So it's a one-way renegotiation. It's a, the odds are on your side that at some point it's going to be a good time to refinance. So Kevin, thanks so much for joining us. I learned a lot, and I wish you all the best of luck.
I appreciate it. Thanks for having me, Matt.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.